Hey traders, and welcome to weekly recap video. My name is Alexander Nikitin. If you guys are new in these videos, I'm talking about statistics. I explain you how you calculate some numbers to evaluate your trading results, and I also demonstrate you my own statistics that I have so far trading this week, trading this month, and trading this year. Okay, let us start. The first thing that I want to talk about today is a drawdown, and I suppose, to my mind, you should think about a drawdown in terms of R's. So what is R? And R is deciphered as risk. So if you set risk to, let's say, 1%, then your R is 1% per trade. If you set it to 5%, then your R is 5% per trade. It is very handy to calculate. It is very comfortable to calculate. So if you have 5 losses in a row, this means that your drawdown is -5 Rs. And if you then have 6 winners in a row, it means that you have +1 R and your drawdown is recovered. You recovered previous 5 and you have 1 on top. This method is good for both for fixed percent money management and fixed fraction money management. So if you always risk, let's say, $100 per trade, then your 1 R will be $100. So -5 R equals to -$500 loss, and +5 R equals to $500 win. Okay, very simple to calculate. And if you use percentages, it is a bit not as simple. Percentage is a bit more difficult because they are compounded. When you have 1% win, your second percent win in absolute numbers is a bit greater than 1. Of course, but you still can calculate that as percentages. Okay, let us start the calculation. And to do that, first of all, what you need to do, you need to choose a strategy and do the backtest. Without backtest, without historical performance, you don't know what results you are to expect and how exactly you are going to repeat the results then you heard about. If you didn't do any backtest, you only have a strategy that you heard about. Let me just take a moment to explain you something, to explain my beliefs, to explain what changed my mind in trading and what turned everything upside down. And I suppose that this, what I'm going to say, this portion of information will also change your mind. So there are 2 types of traders. So the information behind. You can write it down if you want. There are 2 types of traders. 95% are losers. Here, this large L. And 5% are winners. Here, large W. So they are winners. So what is the main difference between the first group and the second group? And the main difference is these guys are looking for help. This is the main difference. They are looking for somebody to tell them what to do. They are looking to find some strategy. They are looking to find some advice. They are looking to find somebody to solve their problems. These guys, on the contrary, are not looking for help. They only rely on themselves. They are not looking to find some strategies. They are creating their strategies. They are not looking for any path to follow. They are creating the paths. So these guys are followers only. They can only follow. These guys are showing the way. So that's why they are professionals. Fair enough, to call this group a crowd, because according to crowd psychology, every crowd individual is looking to another individual and is trying to do what others do. That's why 95% of them will fail. Okay, if you find a strategy that is extremely, I don't know, popular, millions of people using that strategy, and if you trying to implement this strategy, so what is the probability that you will fail? Very high. The probability that you will fail is very high because everybody is doing the same. So you are doing the same that the crowd does. Okay, if you're looking for a strategy, if you are looking for a mentor to buy some training course or whatever, you are acting as a crowd. It is very, very simple. So how the crowd evaluates the information? There are two ways how the crowd evaluates the information. The first thing that the crowd decides the information to be valuable is that the information is costing some money. So let's say a training course is $4,000. So if the training course is that expensive, then the information provided must be valuable. The information provided must be how can I explain it? It must be truth. But in fact, it only costs $4,000 because the seller knows the crowd psychology. That's why. The seller found this information for free somewhere. Maybe he found that information. Then he wraps the information into some beautiful wrapping, into some beautiful coverage, using some presentations, PowerPoints, videos, and so on, courses. So it starts looking extremely great. Then he is advertising his information, praising his product, and then he sells it to you. So the value of this information is equal to rubbish, but crowd pays for it, and crowd thinks that the information is valuable. So beware of this stuff. Buy some information. It is nonsense. So what you buy somebody telling you something. Instead, you could do your own market research, looking at these bars, analyzing these patterns, or whatever. You could do it yourself, and you had 100% reliable information, because this information is given to you from the market itself, and the only investment that you did is your time and effort. You spent your time analyzing these patterns. Okay, see it? And you don't need this stuff. This is not reliable information. This is reliable. So 100% reliable information is given you from the market itself. Not from somebody, but from the market itself. So you don't listen to me. You go and start backtesting today. Okay, second thing. The crowd believes the information. So believe, no, not believe. Let us call it trust. So if the information is expensive, then the crowd automatically thinks that the information is valuable. And that's why the crowd trusts the information. The crowd also trusts the information when he sees other members of the crowd, let's say millions and millions and millions of guys doing the same. Millions and millions of guys are doing the same. That's why crowd also trusts the information. But guys, you should keep in mind the rule of 95%. So millions of guys Of course, they are not that 5%. 5% are not millions. 5% of guys are very few of them, maybe a few hundreds. Millions of guys doing something most likely are the crowd guys. And if one crowd guy is looking to another crowd guy and they're copying him, does this make him a professional? No, he's still a crowd guy. And the second crowd guy is looking for another crowd guy, and they all still do the same. So the sources for reliable information, expensive stuff, and many other guys are doing the same. So this means that the information is reliable. So this way the crowd thinks. Professionals are thinking the opposite way. When they see some information being sold, they simply don't trust that information, because I wouldn't trust that information. If somebody wants to sell me some information, well, of course he will be praising his information, he will be praising his product, he will be trying to make me believe that his product worth the money. Of course he will do the advertisement. It is the same as, I don't know, looking your TV and buying the stuff that is advertised on TV. Let's say this toothpaste or whatever. You see, the toothpaste, it is not given to you for free. You are to pay for it. Millions of other guys are using toothpaste. So it means that this stuff is useful. Well, I have some doubts about usefulness of toothpaste. To my mind, the majority of components that are inside of toothpaste are harmful for your health. You'd better use something else, but not toothpaste. But everybody's using it. Everybody doing the same. Okay, you are watching this video. This means you are looking for somebody to resolve your problems. You cannot resolve them themselves. You are not doing the backtest. You are spending your time for somebody to teach you. You invest your time, your only precious resource. Your time is everything you get. It is much more valuable than money. So you spend your time, you spend your asset, your resource, listening to me. Who you are? A loser. If you spend your time doing the backtest or market research, who you are? A winner. Okay, now, hope you did some market research. Will you automatically become a winner? Not exactly. The strategy and backtested strategy and trading plan is only 10% of your success. I drew this diagram in my previous videos, so you should keep of it in these terms. So 60% is your psychology, 30% not this, 30% is your money management, and 10% is your strategy. So backtested strategy is only 10%. So if you didn't do the backtest, you are less than 10% of success. You have less than 10% chance for success. If you have a strategy, if you have backtested that, then you have 10% of this success. So 30% is money management, 60% of psychology. How you gain that psychology and money management? So the money management is based on your backtesting, on your statistical analysis. Without that, you don't you can't even start using any money management. And your psychology is also based on your statistical analysis. The main psychological thing is the probability thinking. It is also based on your statistical analysis. So if you have a strategy and you never tested that and you don't know how to analyze the results for the strategy, then you are guaranteed loser. You will fail no matter what. Nothing will help. Okay, think about it. I sip my coffee. and we will continue. Okay, suppose you did the backtest. I did, and I found that unified Gartleys, which are a combination of bets and Gartleys, if you trade bet patterns and Gartley patterns, it is the same as you trade unified Gartleys, have these probabilities. Inverse trading, by the way, as 52.53% probability of win and 47% probability of loss if you have 4,600 trades sample size. Not bad, yes, not small number. It is not 100, it is thousands. Okay, today I will be talking about a drawdown. So the drawdown calculation is something that helps you recover after some losses. There are two main mistakes that people do when they have a drawdown. A drawdown is simply a number of losses, yes. When it becomes greater, let's say canceling half of your previous gain, so you start having doubts. So number one reason why you fail is doubt. So this is the sphere of psychology. Doubt. The sphere of psychology. Why you have doubts? Because you never do the backtest and you don't know what to expect. Will your strategy recover, or will it continue to the downside? If you don't know what will happen, if you don't know what to expect, you try to recover it yourself. So what are the two main mistakes that you do? You switch the strategy. First of all, you switch the strategy to something else, you switch the methodology and try to recover. But because of random distribution between wins and losses, you may have it this way, this way, this way, and this way before your second strategy will start a bull run. You see that? This the reason number one why people fail. They are switching the strategy. They do not allow the strategy to show the long-term rising. And the second mistake that people do is looking for confirmations. So what you do, you try to implement some indicators, maybe moving averages, maybe oscillators, or whatever to confirm your entries, trying to have more winners to recover. But what indeed you are doing, you are adding some random variables to the equation. Your equation presupposes this, this, and this, and it was tested this, this, and this way. And if you add, let's say, moving average, you don't know how it will affect the strategy. Maybe with this strategy, it will filter more winners rather than losers, and it will result to what? To this one. Okay, anyway, whatever mistake you do, you still don't know what will, how it will affect the strategy. You still don't know. And if it doesn't give you an immediate recovery like this, you still have those doubts, and you will switch to another strategy. You will look for another confirmation until you blow your account. This happens all the time. I know lots of traders doing that. I know lots of traders. But guys, these traders are losing in spite of the fact they have strategies. They already have strategies. But these strategies were never tested. These guys don't know what to expect. Okay, in today's video, I will talk about the maximal losers in a row. It is interesting stuff to know how many losses in a row you may have maximal in your equity curve, so you can expect when your drawdown ends, if it is a simple drawdown. And we will calculate the maximal drawdown, which is a bit different because you may have a series of losses in a row, which is followed by few winners, and then it continues by some other losses in a row, so the total number may be greater than maximal losses in a row. Okay, so let us start. First of all, the first thing we need to do to calculate maximal losses in a row. So it all starts from if. You type if, you pay attention to syntax, and my syntax says that I should use semicolon delimiters in my formulas. If you have commas, then you should type comma. I'm typing semicolons. So if the result cell is less than 0, it means that I have a loss. Then do the following. Do the increment previous plus 1. If it is not less than 0, then type 0. Very simple. So you see, I had a loss, it calculates 1. I have second loss, it calculates 2. I have a win, it refreshes everything starting from 0. 0, 0, 0, 0. Then I have a loss, it calculates 1. I have another loss, it calculates 2. I have another loss, it calculates 3. So basically, the largest number within this column will tell me how many losses in a row I have. Okay, number of losses in a row. Yes, and the number is very simple. It equals maximal number within this column. 15. So with my strategy, I have 15 losses in a row, maximal. Okay, good. So now let's calculate the maximal drawdown, which can be greater than maximal losses in a row. Suppose every time we lose 1 R, and every time we win 1 R, as I told you in the very beginning. 1 R can be 1% of your account, or it can be some fixed amount of your account, let's say $1. So every time you lose $1, every time you win $1. So it doesn't matter. Then you need to calculate your equity curve. So let's go to choose them all, and let us insert the chart. So the equity curve looks this way. Just paste it. So this is the equity curve and how it looks. So pretty rising. Having some drawdowns here and in the beginning, but on average it is rising very good. Okay, so this is the equity curve, and here on this equity curve you are to find your maximal drawdown. Let us do the calculation. Drawdown, fixed fractional money management, so this abbreviation. First thing that you need to do, you should type equals if. Then if this cell on your equity curve, if this number is more than maximal historical number before that, so you see on top here, and to adjust the formula correct way, it should look this way. If it is more than maximal historical number of your equity curve, then you have no drawdown, you have 0. Else, if it is not more, if it is less or equal to, no, if it is more or equal, then type 0. If it is less, then you should find the difference. Yes, you should calculate this, what you have right now, minus what was your maximal. So the difference between current stuff and maximal stuff. Yes, current point and maximal point. So this is the formula. Pause the video to type it in, and it will tell you what is the largest number. It gives us negative numbers, that's why we will be looking at the minimal numbers here. So double click and it substitutes everything. Max drawdown in R's, yes, and it equals to minimal. It equals to minimum within this column, and it says that my minimum is 49. Although the maximal drawdown is 15, yes, the series of losses 15, then we had some recovery, then we had more 15 recovery, maybe more 15, and only then we recovered back to the upside. So the largest drawdown was 49. As I told you, we are calculating this in R's. So if your 1R equals to $100, then your maximal loss would be what? Let's do the calculation. If your R equals $100, then your maximal loss equals to this, 49 multiplied 100. True, it is this number. If it is $1,000, then your maximal loss equals to this. Very simple. Okay, if it is 1%, 0.01, then your maximal loss equals to 49% of your account. If it is half of your percent, then your maximal loss is only 24%. Yes, if it is 1/3 of your percent, then your maximal loss is 16. So maybe 1/3 of percent for each and every trade you are what you are risking. Okay, so you simply just using your risk tolerance, you simply adjust this. So if it is 2% on your account, yes, then your maximal drawdown is 98. So you're risking to lose almost everything if you risk the 2% on your account. Of course, you will have large returns, but at some period of time you are risking to lose almost everything. So it all depends on how much you decide to risk total, how much you can afford yourself to lose. You see, if you can afford yourself to lose 98% of your account, then you can risk 2% for each and every trade. So keep this in mind when you're trading. Okay, majority of traders simply using 5% of their account for each and every trades simply because they saw somebody is using this way. But guys, you will lose all your money. Even more than all your money. Okay, now let's continue. The next thing, the second part of this video is the practical part. So I just close this window. Let us save it. Then let's go to this one, Metatrader. Open history, start from weekly. Yes, we should download the history for the week. Last week starts from today. It should start from Monday. Okay, the data is downloaded from the broker server. We go to save it as detailed report, replace the existing one, and it is opened in my browser. So you see, here's my trading for this week. It is not very good. I am in a drawdown, and my maximal drawdown is this. Pretty okay. I'm pretty pleased with this. I've lost 26k at this minimal point, and after that I recovered, and right now I am minus 9k from my maximal point of this week, from the maximal historical point for this week. So I recovered more than half of that. I'm pretty confident that my strategy will recover it in the future, and that's why I'm not afraid of these kind of drawdowns. You just saw in my Excel backtest spreadsheet what I should prepare for, yes, and there was a number of this. Okay, then now let's download the data for monthly data. We'll go to custom period, last month. Okay, then we save this Excel spreadsheet, not Excel, sorry, detailed statement. Go back, and here we have it a bit better. So it was rising very good. I suppose the speed of this rise was increased in the end very it was very fast. That's why we had some retracement, maybe because of that. But on average, it is moving to the upside. Same stuff here. The win probability, by the way, the largest drawdown is increased because I think that weekly drawdown starts from here, and my largest drawdown, of course, monthly drawdown, starts from highest point. It is 29k. I lost 29k from here to here, and then I recovered, let us say I recovered half of that, maybe half, maybe more. Okay, so this is my largest drawdown. And now let's examine the yearly performance. Yes, we'll go to custom period, we'll go to 1st January 2019. Okay, the data downloaded, go to save as detailed report and go here. So here's the data for my yearly statement. Okay, it is 51 right now, and largest drawdown is the same, 29k drawdown. Guys, what I want you to do, I want to teach you something that is very useful if you will do this statistical analysis to evaluate your trading results. I want you to teach how to use Excel spreadsheets. So you go here, you right click, you save it as detailed report as usual, yes, but here you type it XLS like this, and change this to all files. And instead of being saved as HTML document, it will be saved as Excel document, and you can do some adjustment here. So what adjustments are needed to evaluate this strategy? The first thing that I want you to pay attention is this profit results. To tell you the truth, I was not placing trades less than 1000 risk. So what are these trades then? What is this 100? What is this 16 cents, 16 cents, 46 cents, 60 cents? What are these trades? They are my mistakes. I simply placed a trade and then I realized that this trade was misplaced, or it was a mistake. I opened buy instead of sell or whatever, and of course I should not calculate them as my strategy performance. I should calculate them as my mistakes. So I should split the performance into two parts, mistakes and strategy. Okay, and to do that I will use filtering. So I'll go to filter, and the first thing that I see, I will delete cancelled trades. Yes, just get rid of this picture first and get rid of this cancelled trade, delete rows. Then I go and disable this filter. Next thing that I need to do, I need to filter these results. I go to filtering, and here instead of selecting all, I should not select those that are less than 1000, because I was not risking less than 1000. Okay, here. So what I do, I just delete them as well. Delete rows. Perfect. Then I go to disable filter. Now what I have is pure strategy results. Pure strategy. Not with mistakes, but my pure strategy. I just delete it if you guys are interested. So these were my mistakes. I deleted 700. Mistakes were 700. Okay, continue. So what we do next? The next thing that we do is this. The next thing that we need to do is to change it back. come on. Let me delete this back. Go and disable filters. Okay, here's the statement, and let's do the calculation. So the starting balance for this equals what I have right now minus my profit that I have. So the starting balance was 31k. I simply copy this, and then I will go here and I will paste it here, value, yes, and then let's calculate the equity curve. So I want you to remember one thing. So I calculate this, plus I add the result, add swap, add taxes, add commissions if I have any, so everything should be added to my results. Double click and it substitutes that till the end. I will delete the stuff. Should keep this in mind. My ending balance is 68 and my ending balance is 67 here. The difference is this 700 trades. So this it might be 68 if only I didn't make those mistakes. It might be, but it is 67. So should keep this in mind, 68. Okay, next thing that we need to do is to calculate the average of this. I will just choose them all. I go to insert, go to graph. Here's the graph. Yes, it looks very much the same as we had in the beginning. So I go to format axis, and the beginning of this axis 27 is the lowest point. So let it start from 27. Okay, now you see the chart looks much better. One more thing that I like about this Excel is this average stuff. So I choose the chart area, then I go to press plus and I choose this trend line. And then guys, let me go to the downside and extend the data. So you see the chart ends here instead of here, so because empty thing. So this is linear average. It is the trend line, and I want you to pay attention to this fact. So when I am deviated from the average to the downside, soon after that I am deviated the same distance to the upside. If I'm deviated from this average to the downside, soon after that I am deviated from it to the upside. You see, average deviations. If I deviate very much to the upside, yes, soon after that I deviate very much to the downside. And right now I am very close to my average, very close. You see this equity curve. So right now I am very close to my average meaning. So this is a wonderful thing about Excel spreadsheets. It helps you to analyze if your deviation is okay or not. After the deviation, you should return to your average, and your deviation should more or less be equal to previous deviation. You see that? Okay, this is stuff number one that is very useful. Another stuff that I want you to see is the mistakes in statistical calculations here. You remember I had number of winning trades 51%, but I had some losses that were actually mistakes, and this statistical block, it calculates them as being losses, but in fact they were mistakes. That's why they shouldn't be calculated. So the total number of trades is 148. So let us recalculate the total number of trades. It equals count of this range from here to here. So all the trades that I took, it equals to this range. count this range. And you see it is 10 trades more, or 10 trades less, sorry. It was 148, now we have 139. Okay, what we should do about these trades? We first copy this formula, yes, press enter, and we go and paste this formula here, and we slightly modify this formula, count if, and we add a criteria. Of course, you should keep the delimiter. If your delimiter says to use comma, you should using comma, and we type it this way: more than zeros. Yes, so the criteria is more than 0. It will calculate only winners. Okay, and it tells us that I have 76 winners. Now let's calculate the number of losses. To calculate losses, it is very simple: total trades minus winners. Okay, and now let's calculate true probabilities. My probability was saying that I had 51% or something, yes? So let's go here. 35% of winning trades, but this include mistakes. Now let's go here and calculate the true probability of the strategy. 76 divided 139. So the true probability says 5468. You see, this is the true probability, and the number of losses equals 1 minus this. It is 45%, 45.32. So this is the true probability of winners and losses. Of course, the average win, average profit trade is a bit different, and the average loss trade is a bit different, because this averages include those small losses. The small losses, 16-cent loss, 15-cent loss, you remember that, 49-cent loss. So the calculations include this $11 loss. What is it? Yes, of course they should be different, and to do it, let's use this calculation formula. Just copy, yes, enter, and here we go to paste it within the same range, but instead of count F, it should be average F. You see, average F. Down. Now it's slightly changed. If we go here, yes, and change the formula to average F, and here we should change minus 0, because it should be less than 0 to calculate the average of losses. So you see, it will change. The average loss is 2,100, but standard calculation says that it was 1895. So keep this in mind to objectively evaluate your strategy results. You should understand that here you did mistakes. I know that I did mistakes, and it costed me this number of dollars, 710, yes, but my strategy performs okay. It is almost one-to-one risk to reward, as I try this to be, and it is 54% correct. 54% correct. But maybe some of you didn't know this, some of you, yes, and maybe you could look at these numbers and say, oh, it is 51, I am missing some trades, maybe some winners are ahead, maybe I need to increase my position size and so on. But in fact, it is 54. This is much greater. If you increase your position size right now, and your backtesting says that it should be 52, instead of some winners ahead, most likely there are some losses ahead, and this is not a good time to increase your position size if some losses are ahead. So objective evaluation of your strategy result is very, very important. Okay guys, Hope the information provided here helped you. At least I analyze my results this way. If you are interested in some numbers, I have generated 36k this year, and let's choose this as percent gain, and let us do the calculation of what I have generated divided by the amount I started, and it is 114% generated this year. The average movement of the equity curve looks this way. You already saw this. Deviation to the upside leads to deviation to the downside, but then they are centered around this line. So right now I'm slightly below this line, but that's okay. These are deviations to the upside, to the downside. They mean nothing. Okay, well, that's it for today. Hope you like this video. If so, give me your thumbs ups, and you are welcome to visit my website www.mpstrade.com. You can learn more about the patterns, about the pattern recognition software that draws these patterns, about the fast backtest utility that does the backtest for you, and it records your trades historical into Excel spreadsheets, so you could further analyze them and prepare yourself for your real-time trading. And well, I just think that the information was helpful. I hope to see you next time in my next weekly recap video, and it will be the video in March already. Yes, because next weekend is the 2nd and 3rd of March. Okay, that's it for today. Goodbye.